Alright, in this video we're going to talk about how to come up with a dividend investing strategy. Alright, so coming up with your dividend investing strategy, you need to determine how much you have to invest. So if you're going to invest in mutual funds as your dividend strategy, you often have to have a minimum amount of funds. It's either usually $1,000 or $2,500. If you're investing in stocks, you can get by with less. I would recommend no less than $500. If you invest less than $500, which you are welcome to do, the fees you pay to make the trade, so say it's $5 per trade, it's going to be a high percentage of the amount you're investing. So if you have under $500, just save the money in a savings account or a checking account with your bank, and then once you get the $500, then invest it. That way you're not paying $5 trading fees frequently to say invest $100. It just wouldn't make sense. So for this video, we're going to assume that you're investing in stocks and not mutual funds or exchange traded funds. The first thing you need to do if you're investing in stocks is come up with a list of companies to research. This is fairly easy. There are lists out there, and I'll put a link in the description below, of dividend aristocrats or dividend champions. I won't go into explaining what these are in this video, but this list is a good place to start to find companies to further research. The biggest step, once you've come up with some stocks that you're interested in, is coming up with your entry criteria. So the entry criteria will be a criteria that will exclude stocks and come up with stocks that you can research in greater detail after your initial research. So for entry criteria, I recommend a company that has consistently raised dividends for at least 10 years. Because you're looking for stocks that grow dividends, having a company that's already raised it for 10 years, they're likely to continue raising it in the future. Next is a company that has a price to earnings ratio under 20. This ensures that you don't overpay for the company. If you pay too much for the company, you're going to have to basically wait longer. Thirdly is you want a dividend payout ratio under 60%. So the dividend payout ratio is the ratio of earnings that the company is paying out in dividends. So obviously the lower the better. Having a lower dividend payout ratio enables the company to further increase dividends in the future. Now, a company might have a 50% payout ratio, but if their earnings are continually increasing, as companies that are doing well generally have, this will keep the payout ratio around the same. So just because it's near the 60% range doesn't mean you want to think it's worse than a company that's, say, 20%. But if you're seeing growing earnings and you're seeing a payout ratio under 60%, that's great. Lastly, you should look at the percentage of dividend payment. So here I look for at least a 2.5% dividend payment. This just ensures for the risk you're taking, you're getting a decent dividend payout ratio. If it's less than 2.5%, it may not be worth it. It's really a judgment call. There are some dividend growth stocks that pay 1.5% that I invest in, but generally getting started, look for around 2.5%. All right, thank you for watching. That's a high level on a dividend investment strategy. Don't forget to subscribe, because we'll dig into a lot of these terms for dividend investing and other questions you may have in further detail in future videos. Thank you.